We've just torn through a stack of IBM's Q3 2025 earnings materials, charts, remarks, the whole lot. And our job today, well, it's pretty clear. Cut through the noise, give you the strategic story. What's really fueling this accelerated momentum we're seeing, and what's it mean for enterprise tech?
Yeah, the big headline they're pushing is definitely acceleration. IBM beat expectations pretty much across the board, revenue, profit, cash flow. And because of that, they've raised their outlook for the full year. The core strategies, hybrid cloud and more AI, they're clearly paying off.
Okay, let's get some numbers out there first. What's the snapshot look like for Q3?
So total revenue hit $16.3 billion. And the key thing here is that's up 7% year over year at constant currency.
7%. That's their best growth in quite a while, right? Shows things are picking up speed.
Exactly. Sequential acceleration across every segment. Then you've got operating EPS, earnings per share, up 15%. Profitability looking strong.
And cash, free cash flow.
$2.4 billion for the quarter. Solid number.
Okay, you mentioned constant currency there. Let's just quickly explain that for everyone listening. Why do we focus on that CC number?
It's super important because IBM operates globally. Exchange rates swing wildly sometimes, and that messes with the reported dollar figures. Constant currency basically strips out that noise. It shows you the, let's say, real underlying business performance, that 7% growth. That's genuine demand, not just currency fluctuations.
Got it. Shows the actual business trajectory. Okay, let's dig into the engine room then, the software segment. Biggest piece, right?
Yep, $7.2 billion in revenue, and that was up 9% constant currency. This is really where that hybrid cloud and AI story has to deliver.
And is it? What are the signs?
Well, yeah, it seems to be, especially when you look at the pipeline. They highlighted this metric, the GenAI book of business.
Yes, I saw that.
It's now over $9.5 billion since they started tracking it. That includes deals signed, consulting bookings, everything related to GenAI.
$5.5 billion.
Wow.
That's a big number. It signals future revenue coming down the pipe.
Precisely. It shows the speed, the velocity of adoption they're seeing. That's maybe more impressive than just the quarterly revenue figure itself.
Okay, breaking down software further. Automation seems to have really popped.
It really did. Accelerated to 22% growth year over year. That's partly organic, but they also called out the HashiCorp acquisition, providing an early boost.
HashiCorp, they mentioned its best bookings quarter ever.
That's what they said right after the acquisition closed. That's, incredibly fast synergy realization, a big win.
And the foundation underneath all this.
Yeah.
Red Hat, hybrid cloud.
Still the backbone. Grew 12%. And if you look at annual recurring revenue, the ARR, that's the sticky subscription money.
Right.
OpenShift ARR, their main container platform, hit $1.8 billion. And that's growing over 30%.
30% growth on nearly $2 billion ARR. That's strong.
Very strong. And the total software ARR base is now $23.2 billion, up 9%. That gives them a really stable, predictable base.
Okay, let's pivot to consulting. The numbers here look a bit different. $5.3 billion revenue, but only up 2% constant currency. Management's calling it a positive inflection point. Is that putting a positive spin on it, or is there something more going on? 2% doesn't sound like massive acceleration.
It's a fair question. You do have to look a bit deeper than that headline number. The sources make it clear that the growth, the acceleration they're seeing is almost entirely from generative AI projects.
So it's the type of work that's changing.
Exactly. They booked over $1.5 billion in GenAI consulting deals just in Q3. And maybe more telling, the actual number of GenAI projects they're running has more than doubled compared to last year.
Okay, so they're capturing that demand for AI implementation, which is presumably higher value work.
That seems to be the case. And that ties into their profitability there, too. Consulting segment profit margin expanded by 200 basis points.
200 basis points, so 2 full percentage points.
Right. That's a significant jump in efficiency for a business that size. They hit their highest consulting margin in 3 years. So they're not just busy, they're getting more profitable doing this AI work. That demand is turning into efficient delivery.
That internal efficiency focus is interesting. Let's hold that thought and shift to infrastructure, because this was the big surprise for me.
Yeah, this segment often flies under the radar a bit.
$3.6 billion in revenue, up a huge 15% constant currency. In a world dominated by hyperscale cloud, how is IBM infrastructure growing like that?
It's almost entirely one story. The mainframe. IBM Z, revenue for Z was up an incredible 59% year over year.
59% for the mainframe.
59%. It was the highest third quarter revenue Z has seen in almost 20 years. The current platform, the Z17, is just having a monster cycle.
Why now? What's driving this mainframe renaissance? They mentioned MIPS.
Right, MIPS, millions of instructions per second. It's just raw processing power for the Z platform. They shipped 130% more MIPS capacity this cycle compared to the last record-breaking cycle, the Z16.
130% more compute power sold. That's massive. So why are companies buying so much Z capacity in 2025?
Because IBM has positioned it, pretty effectively it seems, as purpose-built for AI and hybrid cloud. It's not just a legacy box anymore. It handles the absolute core systems for banks, insurers, airlines, the really critical stuff. And now it integrates things like real-time AI inferencing, quantum-safe security. It's become relevant again for these new workloads.
And this connects back to the software strategy, doesn't it? This huge hardware spike isn't just a one-off revenue hit.
Exactly. This is maybe the most crucial strategic point. The sources explicitly state that the strength of this Z17 hardware cycle creates significant future value for their Z software business.
How does that work?
Well, historically, for every dollar of mainframe hardware IBM sells, they tend to generate 3, maybe 4 times that amount in high-margin recurring software revenue over the platform's life. Software licenses, maintenance, middleware.
So by selling 130% more hardware capacity now,
They're essentially locking in a much bigger pipeline of that very profitable software revenue for years to come. It's tremendous leverage.
that is fascinating. And they're not standing still on the hardware innovation either.
Yeah.
You mentioned something called the Spire Accelerator.
Yeah, that's coming in Q4. It's designed to bring advanced GenAI and that real-time inferencing capability directly inside the Z platform, embedding AI even deeper.
And they're still pushing the boundaries with things like quantum too, right? Long-term bets.
Absolutely. They reiterated the goal, demonstrate the first error-corrected quantum computer by 2028. They mentioned recent progress, like a partnership with AMD, installing Europe's first IBM Quantum System 2, keeping that long-term roadmap visible.
Okay, so they're selling all this tech, but you mentioned internal efficiency earlier. They seem to be really pushing this client zero idea using their own stuff internally.
They are, and they gave a concrete example, Project Bob.
Project Bob.
Yeah, it's an AI tool for their own software developers. Over 8,000 IBM developers are using it.
And the results.
Pretty staggering, actually. They reported average productivity gains of 45% for developers using Bob.
45%?
Yeah,
That's huge for developer productivity.
it really is. And they tied this directly back to their financial goals. They said they're well ahead on their internal productivity targets now.
Did they quantify that? The savings?
They did. They now expect $4.5 billion in annual run rate savings exiting 2025, driven by this internal AI adoption and process improvements.
$4.5 billion. Wasn't the original goal something like $2 billion?
It was. They've more than doubled their savings target. So this isn't just about selling AI. It's fundamentally changing their own cost structure and boosting margins from the inside out.
Okay, let's connect all these pieces back together then. High margin software growing, consulting finding its AI footing, infrastructure providing this surprising boost, and future software leverage. How does it all add up on the bottom line?
The main theme is operating leverage. They're growing the top line, especially in profitable areas, and they're simultaneously getting much more efficient internally.
And the numbers bear that out. Margin expansion.
Definitely. They highlighted 9 straight quarters of operating pre-tax margin expansion. This quarter alone, Q3, operating pre-tax margin was up 200 basis points, and adjusted EBITDA margin expanded 290 basis points.
Nearly 3 points on EBITDA margin. That shows the cash operating performance is really improving.
Exactly. Scaling the good stuff, controlling the costs.
Which, naturally, flows through to cash generation, free cash flow.
Yeah, year-to-date, FCF reached $7.2 billion. That's up $600 million compared to last year. They actually called it their highest year-to-date FCF margin in reported history.
Strong cash flow. And what are they doing with it? Capital allocation.
Sticking to the plan, mostly. They returned $4.7 billion to shareholders through dividends year-to-date, showing that commitment. And the balance sheet looks healthy. Ended the quarter with $14.9 billion in cash on hand. Debt's around $63 billion, but the cash flow comfortably covers that.
So with all this acceleration software, the consulting pivot, the Z surge, the internal savings, it's no surprise. Management sounds confident. They raised the full-year outlook.
That's the bottom line, yes. They bumped up the guidance. Full-year revenue growth, constant currency, now expected to be more than 5%.
More than 5%, up from what previously?
They didn't specify the prior exact number in these remarks, but more than 5% implies increased confidence from whatever the previous internal target was.
Okay, and the really big one, free cash flow.
Raised significantly, now targeting about $14 billion for the full year. That reflects the profitability improvement and those productivity savings really hitting the bottom line.
14 billion in free cash flow. That's a powerful number. And margin expansion outlook.
Also raised, now expecting operating pre-tax margin expansion of over a point for the whole year. So better growth, much better cash flow, better margins, the whole financial picture improved.
Okay, so wrapping this up, what's the core message?
I think that's right. And the driver is clearly enterprise AI adoption, built on that hybrid cloud foundation they've been laying for years.
So how should you think about the IBM model now?
It really seems to boil down to three things working together. One, get that organic growth accelerating, led by AI demand in software and consulting. Two, use smart M&A like HashiCorp to plug into high-growth areas, especially around AI and automation. And three, use their own AI tools like Project Bob, that client zero concept, to drive major internal productivity, which boosts margins and funds future investment. It's a kind of virtuous cycle.
A compelling story connecting external market shifts with internal transformation, capitalizing on their strengths while pivoting effectively.
Which leaves us with maybe one final thought for you to chew on. We talked about that incredible IBM Z hardware growth, up 59%, shipping 130% more capacity. And we established that historically, Z hardware sales lead to 3 to 5 times that value in future software revenue.
Right, the software annuity.
So if AI inferencing, that real-time AI processing, is now a key reason clients are buying all this new Z capacity, how much of that future high-margin software revenue is now directly tied to the AI capabilities embedded in the hardware sold today?
Are massive mainframe sales now essentially a leading indicator for future AI software subscription growth on the platform?
Could be. That link between the physical capacity sold for AI workloads today and the recurring software dollars it generates tomorrow, that might be the real long-term kicker hidden in these results. Something to watch.